It's on there.
It's preparing it to go live right now. I can see that. Okay.
Let's see if I can. I don't think I can do that. Okay.
Hi, welcome to our Zoom info on how rising interest rates can affect your monthly mortgage payment. My name's Lisa.
So Lisa is going to be our MC today, and I have the pleasure to introduce Lisa to everybody. Been a realtor in our local market here in the Vegas Valley for over 20 years. During this time, she's prided herself on being on top of all different types of real estate transactions and situations. No transaction is too complicated for you. Created the tagline, helping buyers who think they can't buy and helping sellers who think they can't sell. And she means that. She was one of the leading short sale agents in town when those things were popular. She helped many of her clients get back on their feet financially. Personal note, Lisa and I have been partners in our real estate business for about 10 years now, and I consider her a great support and a great friend.
Thanks, Andy.
And I have the pleasure of introducing Andy today. He's also been a licensed realtor for over 20 years in the Las Vegas market. He's assisted hundreds of homeowners to reach their dreams of home ownership with his patience and understanding of what their needs are. He's taken on the specialty of focusing on the many local veterans who need to have an agent that understands what it takes to be able to use their VA benefits. His clients say that he's an absolute joy to work with, incredibly available at all times, and always has their best interests at heart. He and his wife, Olga, love nature, hiking, and other outdoor activities.
Thank you.
And I think Andy was going to introduce Christine. we got him unawares.
Christine Donovan is Orange County's 5-star realtor who founded her own company in 1999 after a successful career as a corporate attorney. Walking in the footsteps of her family, she's a 4th-generation realtor who shares her knowledge through public speaking and over 100 articles and media appearances in both national and local media. Her extensive experience in mortgage options allows her to guide her clients to creative solutions that fit their specific needs. As an attorney, she is qualified to help her clients understand and navigate the legal complexities and guidelines of the real estate process with confidence.
She's really nice too.
She is very nice.
Thank you, Lisa.
Christine is very nice.
And I get to introduce Diane Corbin, who is a lender with All Western Mortgage. And I'm going to let Diane tell you a little bit about herself, but I have to tell you how I met Diane. Many, many years ago, I had listed a house for sale that and the person who bought it was an investor, and he was flipping. And the house was supposed to be like 2,000 square feet. And I went over to look at it to list it. And I walked in that house and I knew that's not how big it was. The tax record was wrong. Anyway, so we went into contract, understanding that the house really wasn't as big as they thought it was. And the buyer all of a sudden lost his financing. And I think it was because he was a personal friend of his lender. Well, the other agent brought Diane in, and I knew we had to close because we were going to be in trouble if we didn't close on time. And she made that loan happen, I don't know, less than 2 weeks, a week. It was amazing. I have loved Diane ever since and given her all of my business because, you know, who can do that? Well, she can. So Diane, tell us a little bit about yourself, although we know you're awesome. So
Thank you, Lisa. I've been licensed for over 16 years now, and I strive to always be the one that makes it work. There's always it's a puzzle to do a loan, and every client is different. They all have different circumstances. I do everything from FHA to conventional to portfolio because everybody has different needs. So my strength is problem solving, as well. I like the easy ones too, don't get me wrong, but I can problem solve and figure it out. So the good part is with our company, we have a lot of different products to offer. And, I just enjoy working with people and helping them make their dreams come true. And of course, Andy and Lisa have been phenomenal and love working with both of them, for all these years. And it's a pleasure.
Yeah, well, and that's why we get along so well, because we never say die. We're going to make it happen.
Nope, yep. There's a way to make it work. I'm going to figure it out.
That's right. That's right. So we thought we'd start out with a little bit of market overview for the Las Vegas area and then Southern California. So Andy's going to share a little bit about that, and then Christine will share a bit about that Southern California market we all love.
So our local market here in Clark County has continued to remain very competitive. Prices have gone up quite a bit since the pandemic started, which was a surprise to a lot of people, but things really haven't slowed down since it started. Inventory is extremely low. I actually looked online today and we have less than 1 month's supply of inventory, 0.7 of a month. So in a healthy real estate market, you should have around 6 months inventory. That would make it kind of balanced. And we've been well under that for several years. When we're doing better, we're having 3 months, but now we're under 1 month. So like I said, it's very competitive. Prices are still going up. We don't expect them to go up too much this year, hopefully. Most experts are saying that they think it'll rise around 6 to 8%, which is more of a normal market than what we've been experiencing the past couple of years where we've had, heavy double-digit appreciation. Many people across the valley are worried that we might be headed towards another bubble, but most national economists don't feel that would be the case. The loans that people are getting today, they're qualified for, which is something that wasn't happening in the past. So someone who's buying a house today is assured that they should be able to make their payments based on their jobs and their income. The truth of the matter is, even if prices did go down a little bit, which I don't think they will, if interest rates go up, which they're definitely going to do, that's going to make a bigger difference than if the price of the house goes down slightly. And that's pretty much where we are in Vegas. It's a hot market. I just put a townhome on the market yesterday for $350,000, which is kind of aggressive. And I've already had in 24 hours about 6 showings. And I'm expecting I'll probably get a couple offers within a day or two.
And we know it's a really fast market. It's because we've had more closed sales in the last couple of years than we have in the past. So one could argue it's not necessarily a low inventory, but it's really fast. So as soon as something comes on the market, it sells. At least that's definitely what we're seeing here. What's going on in Orange County, Christine?
Here in Orange County, California, it's the same story. We have, like you say, whether it's limited inventory, it's hard to say, but it's definitely a fast market. In Orange County, looking at the last 6 months, we're 8 days on market average, which means things are flying off the shelf. Like Andy was saying, if you look at 4 to 6 months being a balanced market, that's 1 week. That's not months. And so things are just moving like crazy. What that means is a lot of people are up against a number of people who are bidding. We've been in a seller's market probably since maybe about 2013 for the most part. Nothing like this though. 2, 3, 4 months of inventory. However, since the first couple of about 2 months after the pandemic started, we've just continued to fall and fall and fall in how quickly inventory is selling and how much we have. Prices we're looking at about $890,000 in our median prices. So our prices are definitely up about 14%. We're seeing nothing here that indicates we're going to have a major drop in value or a major drop in people wanting anything. When we looked at the beginning of this year, the number of homes for sale were at our lowest ever since they've been keeping record of it. So really, if things are coming on, they're going off so fast that really we do have low inventory as a result of that. And like Andy said, the economists that I'm listening to are saying the same thing. We'll probably see a fairly modest increase in prices this year. The expectation is that interest rates are going to rise. However, because the way homes have been sold in the last several years and the loans that people have are not the same kind that we had that led to the crash in 2008, the expectation is not that we will see the kind of price correction we saw for the reasons that happened back then are not currently, as I understand it, available in the market that we have these days.
So the purpose of us here is to talk about those rising interest rates and how they're going to affect someone's ability how it is going to affect their monthly mortgage payment, and also will prices go down enough to offset that. And that's why we have Diane here.
Yeah, thank you. So one of the things I'm hearing from clients and agents is because the rates are going up, they're afraid they're not going to be able to buy, or they're getting outbid on properties and they're worried about spending a little bit more on the house to get the property. And what you're finding is with, I've got a screen I can share that shows what the basically buying power is with the same purchase price. I did it on one of your listings so that we could use a property that you had. If I can share a screen, you should be able to see.
Can you find your green button?
Yep. And
There.
you see, can you see the screen?
Mm-hmm.
Okay, so basically this is showing buying power for a $647,000 loan amount in putting the minimal. And you're looking at, just put basic rate in there with no discount points or anything. Are you able to see the flyer? Because I can't see you guys.
Yes, we can see the
Okay.
flyer.
So basically it's showing you as of now and today's rates, just with normal credit, $647,000 loan and the estimated payments with that. And then if you look at what it would take as the rates increase. So if somebody decides, they say, well, maybe I don't want to overpay or bid above list price on the property. And then they say, here is the waiting. Maybe I'll wait for the next one. It just shows as the interest rates go up, how much their buying power is diminishing. So you go from 647 down to $637,000 loan amount for that same payment amount at a 4.115 rate, for example. So it's not going up very much, but it's diminishing their capability of what they can qualify for. Right. So if you're set, whether you're set on that type of payment or you're set on the purchase price and the loan amount, you're either going to have to come up with more funds as down payment to keep you in what you qualified for, if it was that payment range, or you're going to be priced out of the market. There is also on this other screen, you see this cost of waiting flyer. Okay, so with the cost of waiting, it gives you an example in the townhome that Andy was talking about, $350,000 with just estimated homeowners insurance, includes the taxes and all that.
Yeah, but doesn't she have to be in tune with it here?
Can you see
Charlotte, mute yourself.
what happened?
It's okay.
Can you hear me?
Yes.
Oh, sorry. Okay. So it just shows you an example, 350,000, which is very moderate price anymore around town. Shows you the cost of what it's going to change waiting for, say, 6 months or a year. If you decide, instead of jumping on the bandwagon now because you want to see, do prices drop? Is anything going to change later on? Rates are going up. With the combination of those, this example gives you the changes in what it's going to cost you and then the increase of what that property value is. So if you look after 6 months, the property at a normal appreciation would go from 350 to 366, 515. And then after a year and 2 years, after a 3-year period of time, that $350,000 home at normal appreciation would be worth about $406,524. So even if you were going in on a property and saying 350 now, you had to bid 355 in order to win that bid on the property. It just shows you for keeping it for a short period of time, the amount of equity that you're going to gain in that property, right? So there's huge savings, and it does the cost analysis, the total cost of waiting. If you waited 3 years and didn't buy that property, you're looking at $74,846, right? It's a lot of money. So the urgency factor, people got priced out of the market from waiting, just even from last year to this year, that they weren't ready for one reason or another, weren't prepared. There's so many things that you can do to get in a house, down payment assistance programs that we have, ways to make it work, even for borrowers that are self-employed, maybe. We have programs that they can use if they can't qualify the normal standard way. And even though rates may be higher, when you're thinking about what your trade-off is for the equity that you gain in the property in a short period of time, you're best suited to get in and take advantage of that, if that makes sense.
Yes.
Yes.
Okay. There's also the lovely rent versus own. Then tell me when to stop. But
Go ahead.
when you're looking, at the rising rents, because I hear it from clients all the time, their rent, the landlords are increasing rents not by $25 or $50. They're increasing them by $200, $250 because the rent, it's tough even getting rentals. And when you're looking at this buying versus renting, it gives you that same analogy of initially it's a little more expensive in the first year of rent versus the cost of buying a home with your down payment and so forth. But if you look at this over a 5 to 9 year period of time, you're getting the net gain on this house of $235,000. So it's huge instead of throwing the rent money out the window to build that equity in your own home. And this is always factored just by the typical appreciation, not the craziness that we've had with the markets going up so high.
Well, and by buying, you're locking your payment in. Nobody can raise your rent.
Correct.
And when you're renting, you're never really sure what's going to happen from one year to the next. When you buy, you have your house payment, and that's what it is.
Yeah, you're locked in for the 30 years, and you also aren't given a notice to move in 30 days because your landlord also sold your home that you're renting. I've had a lot of clients that had to find something very quickly because of the fact that the landlord decided they were selling, and they either had to go pay now, try to find a rental, or find a property. So much more secure in building the equity for yourself and having that to use. May not be your dream home sometimes starting out as your first home, but to build that kind of equity in a property in a short period of time, you've got money for your next down payment and the next home.
Right. Which is what we're always being told, buy that first house so that you can gain equity to buy that second house and keep the first home. So I know we have both Christine and Andy have some slides to show about how rising interest rates affect your payment. So I'm going to ask Diane to stop sharing her screen for a minute.
I have to see that.
Average rents in the valley are now up in over $2,000 a month, which is so much higher than it was just a few years ago.
Yeah.
At $2,000 a month, you can definitely afford to buy, a place to live in instead of renting. I mean, Diane, I don't know if you know close to the top of your head what $2,000 a month would get you in a payment, a price for a house, but I know it's better than throwing your money away.
What are you asking? I'm sorry, Andy, what are you asking?
I'm saying like the average rent now is up in over $2,000 a month in the valley, which
Okay.
is a decent price to be able to buy something, I think.
Right. I don't know if you guys can see what I just put up.
I can see that. And
Yeah.
to Andy's point though, I mean, regardless of whether you're renting or whether you're paying a mortgage, you are paying somebody's mortgage.
Mm-hmm.
It's just a question of whether you're paying your own or your
Yes.
landlord's. That's all it is.
Right. anyway, and so Andy had prepared this particular slide that shows that what the difference in your payment can be if you're waiting, if you're waiting, because we're pretty sure Diane didn't exactly speak to this, but are you pretty much assuming that we're going to see a rise in interest rates this year?
Yes, their feds are talking about raising the interest rates, the Fed funds rate 3 times this year. And what normally would be affected along with that is you have a lot of the investors on the secondary market that they're backing off of buying the mortgage-backed securities. And that's causing more volatility and unsettling for the investors because they will not be able to sell those loans off their portfolio. So what that means to the homeowner is that they're going to be looking at higher interest rates between the Federal Reserve increasing rates. We've got inflation issues as well. They're talking recession, different factors that are causing the markets to be a roller coaster, which is expected with that news. But when you're looking at those difference of rates, I've got a chart from 1991 to current, and where the rates have gone, they're still historically low. So, probably a year and a half ago, maybe, we were looking at rates in the 2s, and people, fixate on that factor that rate is so low. And even at that time, I had people that literally said, well, I'm going to wait and see if it goes down more. Well, knee-jerk reaction, when it goes back up, it goes back up, and you pass through those. And, now when you're looking at the interest rates, you're in high 3s and low 4s, and depending on scores and loan to value. But even at that, we are still so far below where rates were just 10 years ago. And they're still phenomenal, and your buying power is still great with these rates. So you don't want to wait 6 months, 8 months, a year to see what the feds do, because of the fact that you will qualify for less money for the same payment because the rate is higher. So it's much better to get in while you can, finding a house, of course, with inventory.
I've had clients. Go ahead,
I'm
Andy, sorry.
What that slide was showing, Lisa, if you had it up, was that even though in that example there, the price of the house went down $11,000, rate went up, like I believe it first example that you had up there was 3.89 and it went to 5%. And you could see that over the course of the loan, you're going to be spending 70 some odd thousand more. So it shows you, even if prices were to dip slightly, you're still going to be paying more, because we know for sure rates are going to go up. And that's pretty much a given.
Right.
You have to base it on that. Prices are going to do what they're going to do, but rates are going up. So with that knowledge, for sure, you sitting on the fence is probably not the greatest idea. Again, this will show you too. It shows your buying power at different price points. And once the rates go up, your buying power is going to be a lot less. What you could afford based on a 4% rate is going to be a lot less than what you can afford at a 5% rate. One of the seminars that Lisa and I took recently, they said every time, and Diane, you could correct me if this isn't right. They said something to the effect of, rates go up a point, it's going to cost you about 10% more.
Right.
A month. Yeah, I think that's really important to emphasize, that for every point that the interest rate goes up, your house payment would go up 10% a month. That's a lot.
It's a lot.
Yeah.
And that's why it's important to lock in where you are now. And if you qualify for what you're looking for, finding a property now versus waiting, you're much better locking that in, because you're getting in so that you're not pricing yourself out of the market, where the housing prices that are going up, people, it may go up $5,000, $10,000, and along with a rate increase, they can't qualify, so it's important to grab where you are now, and be able to qualify debt ratio wise, because the incomes are not going up along with these prices and rates, right? You know, the general population with the income and wages that they're earning, it becomes an issue that you're still capped at a certain dollar amount regardless. So if you have to adjust where you're looking for that same house that maybe was 350 and how many square feet, how many bedrooms, bathrooms, you know, 6 months, 8 months ago, what is it now? It's over 4, probably, right? I mean, there's a big jump and you're getting the same property. So it's important to not worry about that quarter of a point, or, you know, that you think it's too high right now, that it's going to come down, because they know they're going to change. It isn't going to change. Yeah. And the equity that you gain, even if you got in a property and it's a little higher than you thought you wanted to spend, taking that equity in that property down the road, you can always refinance. You know, when you hit an 80% loan to value, what a lot of people don't realize, I've got clients right now, their rate on a refinance is much higher than where they were 3.5 years ago. However, they're getting rid of mortgage insurance. So their payment is actually, because values have gone up so much, they're actually dropping their payment even though the rate is higher. So, you know, it really is something that you have to think about, and don't focus on rate, because a lot of people just hear a number and they think, oh, I have to be stuck at this, I want this interest rate. Doesn't matter when you're looking at overall savings that you've got in that property, and being smart about it.
That's a really great point, Diane. Thanks. Christine, did you have something?
Just something that I've had to explain to buyers lately as rates have started to go up. Had a buyer recently, 3.25. I can't do 3.25. I wanted something under 3. Okay, let me explain something. When I bought my first house, my interest rate was 8.375. And she said, wait, what?
Uh-huh.
And she said, why? I said, oh, it was worse than that when I was a kid.
You were a kid when I bought my first house, and I think the interest rate was 13%.
See, it's all perspective to a certain extent.
Mm-hmm.
And it's a whole different thing at 8.375 versus 3.5 or 3.75. And when you look again at, I think you were saying average interest rates, 6%-ish, 6% give or take over time, interest rates are low. And people they get fixated, like you said, Diane. And sometimes I have to explain that to them. And that really seems to be a wake-up call for people when I say things like that. So
yeah. They do think that you can find it, and like you said, they fixate on a rate because they think that is the important part of the whole equation. We all want the best rate, the best price. I mean, that stands to reason. But when you look at the whole dynamic of the market, the value of the properties going up, and, combination, if the payment is affordable for you, regardless of what price and rates and all of that comes down to, look long-term, or just in their interim, you see in 2-3 short years, and that goes by quicker than you think, you've gained that equity that now you can refinance or sell and go into another property. The chart that I've got just shows from 1971, the rates, and, in the 80s, it was up to 18%. Which is, unheard of and crazy when we think about it, because in the normal time frame, we're all focused on the lower rates, but you're going to be going up over 4 easy. And there's also discussion about people buying discount points or buying the interest rate down. I talk to clients all the time. Sometimes it doesn't make sense to do that. Depends on what their goal or plan is for that home. If they're going to stay in it 5 years and then want to be able to move up, you don't want to pay the discount points to get a lower interest rate, because you're not going to benefit from it. You're not in the property long enough. So the interest rate should not be the focus. It's, does it work for you payment wise? Does it work for you all the way around, and what the ultimate goal is?
Great. Thanks, Diane. Some of the things that I've been hearing, people say to me, well, there's going to be all these foreclosures coming on the market because people had their, took advantage of the moratorium. Yeah. But my understanding right now is that barely 3% of mortgages are in default right now. And in fact, just what I'm seeing is that banks are perfectly happy to tack, people have been able to start making their payments again, and banks are perfectly happy to tack the payments. They don't forgive them, they just put them at the end of the loan and everybody's happy. I have to say, when I hear that, I think about when I first realized that the train was coming at us in 2008, might have even been 2006. And I got the first phone call that said, I have to refi my loan and the bank won't refi it because my home isn't worth enough. What am I going to do? And it was like, and I was driving then, I thought, oh my God, here comes the train. And we did see all of those foreclosures and all of those short sales now. But it seems like right now, mortgages are also at a historic rate of performing. And people are staying in their homes. And banks aren't willing to go through that again, because the other thing that happened when I did my first short sale, the person at the bank said, well, why would we sell it short? And I'm like, because it's going down in value, and having to convince banks that this might be the better way to go. And of course, then after a certain amount of time they did, but it was a completely, it was a very interesting experience. And now knowing that banks learned a lesson, if they'd have just let people refi at the payment that they were making then, they would have been just fine. At least that's my opinion. And so that's not going to, I just don't think we're going to see the foreclosures that people think that they're going to see. And it's probably going to take about a year for people to kind of maybe decide, oh, well, maybe not.
I think the other piece of that, Lisa, also is that there's a lot of equity in the properties that we did not have at that point in time. So like I was talking about a bit earlier, I don't think we have the same factors going into this time period that we did in 2008. We've got an increasing market. We've got stronger requirements with regards to underwriting and the loan guidelines. People coming in with more money. They're not coming in with 125% of debt on the property. There's not the same kind of loans available that there were back then. And I think all of that plays into it as well.
And that brings up an interesting question. Diane, are you on refis, are you seeing people take money out of their houses, or are you seeing any HELOCs being given since people do have a lot of equity in their homes?
So a lot of the lenders don't want to do the standalone home equity lines of credit just to, mitigate a situation where people are getting buried in a house. However, I'm getting refinances. I'm doing quite a few for cash out that people are either, with COVID, everybody was home, or a lot of people were at home. They're doing remodeling. They're doing different things on the property to make their home worth more or to get things taken care of. So they're doing cash out refinances, sometimes to get rid of other debts that they have, because they have a lot of that equity in the home. And, with the forbearances, there might have been money deferred and tacked on the back, but they're still above water on the property and have equity that, to the point of foreclosure. I don't see that as an issue, because the fact is if they get to the point that the bank is threatening of making payments, which they're still extending some of the forbearances, they can turn around and sell the house. And with the market as quick as it is because of low inventory, they can sell and they're still walking, with some money after clearing the debt. So, I have a couple clients that, they're trying to figure out what they're going to do if they're going to list their property or whatnot, because of forbearances, deferred amounts, and still will walk with a lot of money. So I don't see the banks having any issue, and they are being smart about it, because in 2008, they learned the hard way because they were being hard-nosed about it, but it was a different situation because the people are also qualified for the loans. So COVID was a little different situation where, okay, a lot of people maybe were off work, they couldn't go into the office type of thing, a lot of people laid off, but they're recovering, and underwriting guidelines are getting back to normal after COVID, which is nice. So we can do a lot more options for the clients as well.
Is there any Oh, sorry, Andy.
That's all right. I just wanted to say that sounds a lot more optimistic than it was in 2008 when people were kind of using their homes as ATM machines and they were going up and they were going up and people were taking money out. I mean, I know people who were taking money out, buying cars, going on great vacations. And I think hopefully most people learn that. I mean, at least if you're taking the money out and you're putting it back in your home, that's a lot better investment.
Right.
Which my question was, is that do bank, I mean, if you're doing a refi takeout, are they asking, are banks asking what's the money going to be used for, or not?
Yeah, so, you know, in general, yes, we want to know what it's for. If we're going to be doing home improvements, if it's going to be for debt consolidation, you know, if they're taking out large amounts of money, obviously they're going to be a little more particular about what they're doing with that, not just taking it out to go, you know, vacation or something. But you are able to take out funds without having to designate what it's for.
Okay.
But they're keeping the loan to values on that better on the cash out refinances. You know, used to be you could do 80%, 85% or more. They're keeping it to 75% of the value of the home. So they're being smart about, you know, keeping everything in line so they still have some wiggle room in case there should be an issue with that client.
But it sounds like from what you're saying, banks aren't doing HELOCs. If you want to take money out for a home improvement, you're going to have to refi.
Generally so, because they want, you know, if they're doing a refinance for a first and second so that you can have your first main loan and a piggyback home equity line, that they don't mind so much. It's getting a standalone HELOC that a lot of them have cut out or frozen, you know, the client's credit line on that, just because they're not sure what that is being used for. So they'd rather have it where it's a little more manageable and they can keep an eye on it, if that makes sense, because they want to make sure that that borrower is not sitting there and taking a home equity line on top of their regular mortgage, and then they're going to be at 90% loan to value, right? So this way they can control it better the other way.
That's great.
Yeah.
I don't have any more questions. I don't think. Anybody else? Are we good?
Yep.
Okay. Well, thank you, everyone. It's been fun. I learned a lot, and we'll do this again really soon. Thanks.